the market is softening. I'm not saying the market is falling, it's just like...
It's falling.
Well, slowly.
Is it an interest rate factor? Is it, what's going on with the budget? Is it all of the above? If ultimately you are trying to take demand out of investing in property, doing that as broadly as possible is the right solution. Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a massive welcome to our community. My name is Bryce.
And I'm Ren, and today we have a big show for you. We're talking all the news-moving markets from Australian property here to British Prime Ministers over in the UK. We have got Pimp My Portfolio. Matt Ingram is back reviewing the portfolio of a community member. And then we are unpacking some research that makes the case for owning fewer, better stocks. But Bryce, we've got some exciting FinFest news. Time is running out to get your early bird tickets.
That's right. If you are listening to this on the day of release, you have 24 hours to grab the final allocation of early bird. They are $40. It's going to give you access to Australia's largest finance festival here in Sydney, October 24th at the Carriage Works.
I mean, $40. It's almost free at this point. These days, you're paying almost $20 for a pint at a pub in Sydney.
Yeah. Well, I mean, the equivalent finance events, and this is one of our big gripes, the equivalent finance event here in Australia is between $250 and $400. So we want to make this as accessible as possible so that you can invite your parents, you can invite your friends, convince people who would never come to a finance event on the weekend to come and actually enjoy themselves.
Yeah, and part of the reason we are able to make tickets so cheap is because we have great sponsors. So we should say a massive thank you to BetaShares for powering FinFest. Tomorrow, so Friday the 26th, the early bird tickets will end and we'll cut over to full price tickets. That's the bad news. The good news is they're still pretty cheap, $55. So if you're listening to this on Friday or later, don't despair. Head to equitymates.com/FinFest and pick up your tickets.
News and markets.
All right, well, headlines we're going to cover off today. There's more bad news for Australian property. Another UK politician or Prime Minister has resigned, and Richard White's latest scandal is really showing us why there is risk in founder-led companies. Let's start off, though, with the Australian property.
Yeah, two news stories around Australian property and then just a general market update. So the first one, let's talk about the budget. It got passed through the lower house with no issues because the Labor Party have a big majority there. But in the upper house, they don't have a majority. They need to negotiate. Negotiations are ongoing with both the Coalition and the Greens. And it looks like to get these budget changes through, the Greens are pushing for another change to property investing. And that is to stop the tax advantage treatment of residential property within self-managed super funds.
I've certainly seen online a lot of people now talk about, don't worry about it, let's just do the same strategy in your super.
Yeah. Well, yeah, I think the Greens have explicitly called out the number of social media property spruikers who are now pivoting to the SMSF strategy.
Yes.
Yeah, because I've seen it as well.
And so really it's saying through your super fund, you will get the capital gains tax discount and the ability to continue in the same environment that we saw pre-budget changes. I don't think this is a bad thing at the end of the day.
The Greens proposal?
Yeah. I think if ultimately you are trying to take demand out of investing in property, doing that as broadly as possible is the right solution.
Yeah. You could mirror the non-super rules where if you want to use your SMSF to invest in property, that's fine. But if you want the tax benefit, you've got to invest it productively, i.e. new builds, not just trading apartments in Bondi.
Yeah. I'd be interested to see how some of the property guys go, should this go through. But certainly seeing a lot of it online at the moment.
And I should say, trading apartments in Bondi was like a butchering of a Paul Keating quote. These days, it's less trading apartments in Bondi. It's more like trading 3-bedroom houses in Wagga or Darwin. But I think what we want to do is what the government wants to do is make residential property a accessible asset class rather than an investment asset. Yeah.
The second part of the story is obviously we're starting to see the housing market slow, and we've spoken about this over the last few weeks, but the latest data that has come through is around auction clearance rates, and we've seen it fall below 50%, which is the first time that's happened since April 2020, mid-COVID, when the property market just sort of the bottom fell out of it. 24% of auctions were withdrawn, with sellers really unwilling to test the market. So, is it an interest rate factor? Is it, what's going on with the budget? Is it all of the above?
Let me partially answer that question. So at least I saw a chart from Sydney. Our auction clearance rate here had been dropping pre-budget. Like it was aligned with the interest rate rises. It was both the rises and the expectation of more rate rises to come. But then in early May, we've seen another significant leg down, which aligns with the budget. So it's been like a combination of all the factors. Cost of living squeeze, interest rate rises, and budget changes have all contributed. There is an argument that this is just a temporary mismatch where sellers still want the old world prices, but buyers expect discounts, and that at some point the auction clearance rate will normalise as expectations realign. But it's likely that expectations realign with sellers realising that the market's softened, particularly in Sydney and Melbourne. SQM Research has forecasts. They reckon for the full year 2026, Sydney will be down 9%, Melbourne will be down 7%.
Wow, that's there. If you're looking to buy, I'd be patient right now.
Well, which is why the auction clearance rate is so low, because people aren't rushing. There's not this frenzy of FOMO. SQM also think all capital cities have peaked, aside from Darwin, and I'm trying to remember this off the top of my head, one other one.
Probably Perth.
Probably Perth. Yeah.
I get a weekly newsletter from the real estate agent that we bought from when we bought in 2023.
A weekly newsletter?
Well, it's just their bloody...
their listings.
What's sold, what hasn't. And the whole thing is just constant, trying to be positive. It's all about seller and buyer expectation alignment. It's like, obviously, what else is going on in the market?
Sorry, I just looked up this SQM. It was actually Darwin and Hobart that haven't peaked.
Hobart?
They're saying, yeah. Now, this is only just one forecast from one person, but I think the takeaway
Probably the two most affordable cities.
Yes. Well, I think the takeaway is the market is softening. I'm not saying the market is falling, it's just like...
It's falling.
Well, slowly.
Yeah. I mean, a 9% drop is a fall.
It's like, oh, wow, it's back to where it was in mid-2025.
Well, I mean, let's be honest. It's never going to be...
affordable.
Like, what would have to happen for it to drop 20%, for example? You'd have to have unemployment over 10%. You'd have to have serious demand destruction.
Or fast brick robotics figure out their bricklaying robot, and we see crazy supply.
But the crazy supply, I mean, that is true. That's only one part of the cost dilemma for supply, which is labour. The materials is also...
If people aren't familiar with fast brick robotics, it's this micro-cap Australian company that has like an automated bricklaying machine. And I reckon a lot of Aussie investors at some point fall in love with the idea of increasing productivity in the building sector. The stock hasn't done much.
No. I remember talking about it when we were at uni. Anyway, a lot going on in the space. We'll keep an eye on it as it all plays out.
Speaking of a lot going on, let's go over to the UK, where a lot is going on in 10 Downing Street. The only people making money there seem to be removalists.
Well said. Yes, British Prime Minister Keir Starmer has resigned. He had incredibly poor approval ratings despite winning a landslide election. It all came off the back of the issues he got in with hiring the...
Peter Mendelsohn?
Peter Mendelsohn, who was an associate of Epstein. That's where it all started to collapse for him. And nonetheless, he has resigned. So it's the 6th Prime Minister in 7 years, or will be the 6th in 7 years. However we want to pitch it.
So he stepped down after Andy Burnham won the Makersfield by-election, and the writing was on the wall, and Donald Trump kind of said the quiet part out loud by tweeting that Keir Starmer was going to resign about 12 hours before he did. So
good one, Trump.
He'd be pretty annoyed at that. But yeah, Burnham, if you've seen the video of him walking in and being sworn in the House of Commons, it's basically a done deal that he's going to be Prime Minister. I think we'll know, the Labor Party will go through their process. I think we'll know by the 16th of July is the date. But I've got a bit of a would you rather. So I've got 3 scenarios for you. I want you to tell me which one you would rather. It's the UK 2016 to 2026, Australia 2007 to 2018, or France 2016 to 2026.
Oh.
So Australia 2007 to 2018, we had 7 prime ministers, if you count Rudd twice. Howard, Rudd, Gillard, Rudd, Abbott, Turnbull, Morrison in 11 years. They averaged 1.6 years each. If we assume that Andy Burnham's about to come in, the UK will have had 7 prime ministers in 10 years. Cameron, May, Johnson, Truss, Sunak, Starmer, Burnham, averaging 1.4. So the UK is shorter than Australia. How about France, though? 9 prime ministers in 10 years. I'm not going to read them all out, but averaging 1.1 per year.
Wow. I mean, you'd have to go Australia. You just want stability at the end of the day, and unfortunately, neither of those, all 3 of those scenarios didn't provide a lot of stability.
No.
Didn't really allow any prime minister to get their legs under them and have a fair crack. But not a great scenario. Either way.
Australia, you probably say that 11-year period was characterised by the climate wars, and we couldn't agree on energy policy and taxation policy around that, and that kept toppling prime minister after prime minister on both sides. You'd say the UK, 7 prime ministers since 2016. This is all a post-Brexit.
Yeah, big time for
They haven't been able to find their feet. No real investing implication for that. Since 2016, the FTSE is up like 70%.
Yeah. I mean, Starmer, while he was in office, I think the FTSE was up about 25%.
Yeah. So
not bad. Let's bring it back home here in Australia, where Richard White, the founder of WiseTech, is under an investigation by the AFP for human exploitation.
So we do have to be careful about what we say here. It's all alleged at this stage, but what we do know is that the AFP's Human Exploitation Task Force is investigating White. The allegations are that he inappropriately leveraged a woman's immigration status and lied on a visa application form. What we do know is that Richard White's company, WiseTech, had a terrible day on the stock market on Monday, down 18% in a day, down 78% from its all-time highs in 2024. WiseTech was a market darling. It was an Australian tech company that was doing amazing things around the world. But I think the investing lesson here, if we focus on that, is there is the risk and reward of founder-led businesses. There's a lot of reasons to like founder-led businesses. There's strong alignment with the founder. They make money when you as a shareholder make money. They are entrepreneurial. They've taken risks. They know this business inside out. They're not like a manager who's been hired to come and just, keep things on course. They've built this and they're continuing to build it. But on the flip side, you're tied to the founder. And if the founder's personal life gets in the way, then the company's kind of tied to that. And we've seen that with WiseTech. We've seen that with Mineral Resources. At different times, we kind of saw that with Tesla, but like the Elon force field has kind of just let him keep going beyond.
SpaceX is gone if Elon leaves.
Yeah. But if you think about Tesla, like the smoking weed, the 420 funding secured tweet, like all this stuff, which in hindsight, we just like look back and kind of laugh because it's Elon. Like when founders screw up and they have such control over their companies, it's bad for the company. And so just in some ways, you take the good with the bad with founder-led companies. You try and only invest in founders that are good. But obviously, you can never really know until it's too late. And so you just make sure you're managing that risk appropriately. Like you're not all in on a person who you don't actually know except from behind a computer screen.
Yes. Well, it's going to be even worse. I think the worst could yet to come, whatever, for WiseTech if he does have to leave. From what the market says, he's still so critical to the business.
Yeah. But arguably, like at some point, it becomes untenable for someone to stay.
Absolutely. I'm surprised he's still there.
But look, I owned WiseTech. I sold WiseTech because the other story that's going on is the AI story. And one of their big customers recently ended using CargoWise, their main product, because they thought they would build it themselves in-house.
There you go.
So I think there's like a 2-track story to watch with WiseTech.
There you go.
There's the product story and the people story.
People said businesses wouldn't try and Claude code themselves. They definitely will. If you want to stay up to date with all of the headlines, make sure you subscribe to our daily newsletter, or you can listen to our news podcast. It's called Headlines. You'll be able to subscribe wherever you're listening to your podcasts. We'll also leave a link in the show notes if you want to subscribe to the newsletter. All right, Ren, well, coming up, we have Pimp My Portfolio with Matt.
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get a community member to submit their portfolio for one of our experts to review to provide some ideas on how it might be able to be improved. Today in the studio, we have Matt Ingram from North Haven Financial Management. Matt, welcome.
Thank you.
And on the line, we have community member Seb. Seb, welcome.
Hello, everybody. Glad to be here.
Thank you for submitting. We are excited to have you putting your portfolio under the microscope. So as always, let's kick off. Ren, what is in Seb's portfolio?
Okay, Seb's portfolio is made up of 5 ETFs and 5 stocks. To start with the ETFs, 2 index ETFs, together 40% of the portfolio. We have the ASX 200 and the NASDAQ 100. Then we've got 3 thematic ETFs, Hack, the cybersecurity ETF, VBTC, the Bitcoin ETF, and Armour, the global defense ETF, which together make 28% of the portfolio. And then finally, we've got 5 stocks. If I just run down the list, we've got NextDC, DroneShield, Tesla, Nvidia, and Telstra. 32% of the portfolio. Seb, you might be the only person in Australia who has both Telstra and DroneShield in their portfolio. But before we get you to explain how this portfolio came to be, Matt, do you have a nickname for us?
I called this one the golf course because there's a lot of holes.
Oh! Love it.
Wow. Brilliant.
Okay,
All
Matt's
right.
coming punchy today.
Good thing I've got a handicap.
Why don't we throw to you, Seb? Talk us through your current approach, your thinking about the portfolio.
Okay, so this portfolio was constructed in 2025, approximately June, July. And it was on the back of some excess funds after paying house off, which is, I'm sure, quite common. So I wanted to make my money work for me. And I won't lie, the Equity Mates YouTube channel definitely inspired, or at least triggered some thought here around investment in this area. So I used to trade a little bit back in the 90s, showing my age, hence the Telstra. And I kept hold of a couple of them and sold them. But this last year was a revamp. So the construction really is about diversification. I saw that as definitely a strategy to move forward with. Yes, there are a few holes in here, and hence that's why I'm here to obviously be scrutinised. And so, as they say, roast away.
All right, well, Matt, where do you want to start here?
Look, the name's a bit punchy. I don't mean it too personally. And I know that's certainly why you're here.
Sure.
The things that jump out, it's a bit of a weird combination here, like Ren said. Things like DroneShield, where, potentially jumping on for a bit of a ride. Telstra makes sense with a bit of the history there. But what really stands out is that the core probably isn't quite complete. And then the satellites, which it feels like you're taking this core satellite approach. The satellites just feel like there's, definitely some thought there, but not in relation to the core. And what I mean is having things like Telstra and Tesla and Nvidia, which you have in pretty high allocations in the core already. You're then just kind of doubling up. And it's either because you're really bullish on them, or you potentially haven't seen through the core to see what's really there in what allocations. And so you're kind of unintentionally doubling up.
Good point on that one. I did want to ride on the bullish nature of course, our friend Elon Musk and his $1 trillion bonus.
Yes.
So I was riding a little bit on that.
Yep.
What a motivator, right? And of course, Nvidia with their essentially their moat approach with their product, of course, and their pipeline for a good 3 to 4 years. I'm sure that will be eroded over time, like any good product. So yes, definitely bullish on that. And I am aware that some of the ETFs have doubled up in some regard from allocation, but I wanted to put a little bit more into those, which are, have been doing quite well in the last 6 months. Yes, they're a bit volatile, but I'm happy to stay the long game.
And there's absolutely nothing wrong with that. If you have a thesis and you're bullish on that and you have your reasons for investing, that's fine. I would then just be mindful of the allocations, right? I've got here about 8% of the portfolio in Tesla, and that might be largely through capital gains. That's information I can't see. But to have 8% in Tesla combined with what Tesla is in the NASDAQ 100, it's getting pretty heavy Tesla, not just Tesla, Nvidia as well.
Yeah.
Matt, focusing on the core, you said that there's a few holes in it. Like what do you need to actually complete this? And Seb, I'm assuming sort of stage of life for you at the moment, I'm guessing, I don't know what you think where you are on the sort of the risk curve, but like capital preservation is probably becoming an important aspect of your sort of long-term financial planning. So I guess marrying those two together, like what's missing from the core that I guess could help with that?
Yeah, well, to touch on that second point, and this starts to get a little bit personal, but I'll just kind of touch on the idea generally, is that, if other matters are taken care of, if super's looking healthy, if the home's paid off, this and that, you can certainly still be taking some risk with this. So if this was all you ever had left, absolutely capital preservation and be very careful. But if this is kind of the surplus money, continuing to take some risk is probably appropriate. With completing that core, right now it's the ASX 200, which 50% of is just big banks and miners, and then the top 100 US, mostly tech companies, of which 40 or 50% is the big 10 anyway. So to broaden that out, things like exposure to other countries, I think is definitely appropriate. When I say countries, I mean, sort of continents.
Yeah.
Yep.
Asia,
So European.
Europe.
Yeah, exactly. Kind of just completing the globe there. And that can come very simply through things like VGS or VEU, names that I'm sure you've heard of before, Seb. With that, you would have 3 or 4 ETFs in the core, and there's probably no need to complicate it any further, and just have a similar allocation to what you've done for the ASX 200 and the NASDAQ and just round it out.
Yeah, good point. Thanks for the tip there. And I have been looking at what's quite known as emerging markets. Mm-hmm. So the VGS definitely was on the radar. And I do want to simplify it to some degree. I mean, it's only a 6-month-old portfolio, but if I can quote you guys on Equity Mates, this is a 2-3 year learning process almost. You stumble along, you learn from that, and then you fine tune and go on. So I do want to rebalance, and 2026 was that time. So hence I'm on here. So emerging markets definitely want to tap into that, mainly from diversification, but also from growth point of view. There's a lot of good news coming out of emerging markets.
Well, I was just going to say, this isn't directly about your portfolio, but you said you started around June or July last year.
Yep.
And I actually think that was a bit of a challenging time to start investing, mostly because you had this big rebound throughout kind of April, May with the post-Liberation Day, and anyone that started around that time thinks they're a genius because they're up 30% already. Since kind of June or July, it's been pretty jittery. The market doesn't seem to know where it's going, especially the Aussie market. And it's probably felt a bit like that for 6, 7, 8 months now. So the fact that you're building this out slowly, you're scoping out the landscape, it's obviously a considered approach. So I just wanted to point that out and say well done for doing that.
Yeah, that's a valid point. And I do recognise that April massive dip, of course, Liberation Day, thanks Trump, because there was a lot of opportunities, and that sort of sparked, it was a combination of this channel, but also of the market itself. And I have been a bit targeted with some of those, admittedly, and some double ups, hence the rebalance. But of course, some of the legacy ones, well, even in Australia here, we talk about thematics and more tech basis, and NextDC, for example. I still believe in some of those stocks that haven't done so well. So I'm definitely going to hold on some of those, considering the pipeline and considering some of the momentum when it comes to AI and so on. Data centers, for example.
I was going to ask, Matt, do you have any views on any of these individual stocks? Any that you love or that you hate?
I don't know. I'm probably not as passionate as some people that you get on here when it comes to particular holdings. But NextDC, I'm completely happy with at current levels, but 8% of the portfolio I think is a bit heavy. Drone Shield, yeah, I mean, it's been talked about a lot. It's a wild ride. It seems to be back, on its way up at the moment. I don't know where you're sitting with that, if you're down heavily or up. But yeah, don't go any more than your current allocation is all I'd say. Telstra, I would just move on from that. To be honest, it had a good run last year, but yeah, you've got quite a bit of it in the ASX 200. Tesla, again, pretty heavy on it. It's not my favorite. I don't personally buy it, but with all of these, like 3 to 5%, I think is a totally appropriate weighting. You're not doing anything wrong. There's nothing in here where I'm like, get rid of that. But it's just a matter of weighting. 8% in a single holding is just a fairly big bet for anyone. So trim it down 3 to 5%.
Sure.
And then the final part of the portfolio that we haven't touched on yet is some of these thematic ETFs. And I'm surprised we haven't, because you've got ARMA, the BetaShares Global Defense ETF in there. And I reckon that's probably one of the buzzier ETFs going on at the moment. I imagine a lot of clients have it in their portfolios, Matt.
Absolutely. Yeah, just about everyone that I work with
Matt loves it.
Matt loves
it. Not necessarily just ARMA. There's lots of ETF providers that do a very similar thing, and so we use a few of them. But yeah, obviously it's a big theme. It's done very well over the last month or so. Could explain why there is quite a heavy weighting to it. So you might think about trimming that down at some point, but definitely keep some good exposure there.
Yeah, that one's based on the geopolitical scenario from last year. And of course, I think that momentum, which is probably going to continue. So that's definitely a standout for me as far as success goes. And there's a couple of others that aren't so much. So thank you for the advice. That's great.
No worries.
Jumping Tesla.
I don't know. Anyway.
Telstra, yes.
Telstra. Dumping Telstra.
Telstra.
Yeah.
Love it. Well, Seb, did you have any final questions for Matt?
Oh, look, I think to summarise, not so much questions, but this show's been very helpful. I've been very much hooked on it. It's entertaining, it's lightweight, and often, and even segments like this. So keep up the good work, boys. I love it.
No, well, we appreciate you listening. So, yeah, hopefully you got some value out of today.
Definitely did. Thank you for your advice.
And Matt, as always, appreciate you coming into the studio as well.
Likewise. Thanks so much. Thanks, Seb.
Find few good stocks and hold them forever, or just buy the index. That is the latest takeaway from a 100-year study of the stock market. Ren, we're going to dig into it because, I mean, the numbers are pretty revealing.
Yeah, so this study is a 100-year study of the US stock market, 1926 to 2025, looked at roughly 30,000 stocks. And we want to unpack what we've learnt because I think the takeaways are pretty profound. And the action to come out of it is pretty clear. This is an extension of a study that was first done in 2017 by Henrik Bessenbinder. He's a professor at Arizona State University, and he published this paper that made big waves in finance. Do stocks outperform treasury bills? It made such big waves that we actually wrote about the original study in our book, Don't Stress, Just Invest. But the study at the time found that just 4% of companies listed on the US had explained the entire gain of the US stock market since 1926. Just 4% of companies have driven all of the outperformance. 96% of companies have done as well or worse than treasury bonds.
Yeah.
The takeaway from that is you need to find those few amazing companies, because it's just 4% of companies that are doing all the work, all the wealth building for the entire market.
Yeah.
And when you put that in context, it's like, well, the US market has done about 10% per year. And so it's like this 4% of companies are doing all the heavy lifting to not only grow themselves at 10% a year, but growing enough to grow the whole market. They're lifting everyone else up to see the whole market grow at 10% a year.
Yeah.
So find those few amazing companies. That was what Henrik told us to do. In fact, he found that just 5 firms, ExxonMobil, Apple, Microsoft, General Electric, and IBM, had accounted for 10% of the total wealth creation from 1926. So that was the original study. He's gone back in the books almost a decade later, recut the numbers, and looked at a longer time period. And Bryce, the findings are even more stark.
So over that period, the US stock market returned more than 10% over the 100 years.
Per year.
Similar to what you said, Ren, most of the individual stocks didn't even outperform cash, let alone the index. He found that less than half posted positive returns. That's crazy. And just 41% outperformed the US Treasury bill. But what is most alarming is that in the original study, 89 stocks accounted for half of the wealth created. But in the last 100 years, that is now concentrated even further, with just 46 stocks accounting for half of the $91 trillion of wealth created. Incredible concentration.
Yes.
46 stocks. And if you think about the most recent examples, we have Apple contributing about 5.5% of the total wealth created over that period. NVIDIA about 5%, Microsoft, Alphabet, No surprise it is the big tech companies. But outside of tech, some of the big ones, you've got Berkshire Hathaway, Walmart, Eli Lilly, JP Morgan. It's really the top sort of 30 to 40 S&P 500s.
Well, yeah, I mean, unsurprisingly, the biggest companies today have contributed the most because they're the biggest.
Yeah.
The finding here is clear. It's that if you want to pick individual stocks, you've got to find those few amazing companies and hold them, because that is the wealth creating effect of the stock market. The challenge is, how do you find them? And so for us, there's like two clear takeaways here. The first is you do the work and you find great companies and you hold them, a la Warren Buffett. Like if you look at the list of companies that have contributed the most, a lot of them Buffett has held. You know, Coca-Cola, Exxon, Alphabet, MasterCard, Visa. I'm assuming he's held Visa and MasterCard.
Yeah.
He's definitely held at least one of them. So that's option one. Option two is own the whole market, because you know that you're going to have that 4% of companies, or however many it is now, in the index.
Yeah, I think that's the takeaway. Yes, you would have done incredibly well if you were very fortunate to pick NVIDIA before it went on its massive run and really got the true wealth creation that it has delivered. Or you got, you know, Apple when it IPO'd many moons ago or released the iPhone. But like, you could have chosen 46 completely wrong ones.
Yeah.
And thought they were still amazing companies. And yes, they would have returned, they may have returned, you know, 6 or 7%, but like, you're still under the market. And let's not forget that the underperformance of over half of these companies is not just underperformance against the index. It's either a negative return or not even outperforming effectively cash.
Yes.
So like, yeah, you could have been better off just putting your money in cash.
Yeah, if you picked the 46 wrong companies.
The wrong companies. So like,
yeah.
It really just illustrates, again, how hard it is to consistently choose individual companies and do well.
And how easy it is to choose the index, because you know that you'll have these great companies, and as they grow, you'll own more of them.
Exactly.
It aligns with another study that we wrote about in our book, Don't Stress, Just Invest, or wherever good books are sold. Jeffrey West, in his book Scale, spoke about the number of companies that have gone bankrupt in the US stock market. Between 1950 and 2009, 78% of the companies that have listed on the US stock market went bankrupt. They didn't just underperform, they went bust. 28,853 companies have traded on the US stock market. 22,469 had gone bankrupt by 2009, 78%. And yet, in that time, 1950 to 2009, the US stock market grew more than 23,000% with dividends reinvested. Put another way, $100 invested was more than $200,000 in that time. And that's just buying the index. That's in spite of more than 3/4 of companies going bankrupt. The story of the stock market is finding those few generational companies and holding them. And our takeaway is there's two ways to do it. Be Warren Buffett and find them, or own the index and be guaranteed that you'll own them.
Yeah. All right. I'm selling my satellite.
No. Have a satellite, but know that your satellite, it's hard. It's hard.
It comes down to position sizing. And I mean, even active managers, be very mindful of active managers as well, because it's no easier for them.
Yeah. And be mindful of their strategies as well. Like if an active manager is over trading, there's a chance that they own these great companies, these 4% of companies, but they don't hold them because they decide they're overvalued. You know, they sold Amazon when it got to a PE of 60, and then they missed the $1 trillion of wealth creation that came afterwards. Investing is amazing. It's amazing how easy and accessible it is.
Yeah.
Have the majority of your money in the index and then try and be Warren Buffett on the side.
Exactly. Yeah, that's how we think about ourselves here. So if you have someone, either a friend or a family member who is, you know, thinking about investing but feeling like it's not for them or they're not ready, send them this episode, get them to listen to this last segment here. Just really highlight how all you need to do is buy the index, and that is certainly all that you really need for good long-term investing.
And if you're getting a bit lost in us continuing to say the index, you're not sure what we mean, head over to Get Started Investing. It's our sister podcast. Jess has just finished her 12-part series where she went from never having invested to building her own portfolio. So go and check that out. That'll get you from woe to go, and then come join us on the journey.
Well, that brings us to the end of this episode. Make sure you grab your FinFest ticket before they flick over to full price tomorrow. It's Friday, the 26th of June. Otherwise, Ren, we'll pick it up next episode.
Sounds good.
This podcast is intended for education and entertainment purposes only. Any advice is general advice and has not taken into account your personal financial circumstances. Before acting on general advice, you should consider if it is relevant to your needs. If unsure, speak to a financial professional. The host of this podcast and their guests may have positions in the companies mentioned. Equity Makes Media is part of the BetaShares Group but maintains editorial independence. We operate under Australian Financial Services Licence 540697.